So we'll get going, guys. I apologize ahead of time for this session. We don't have a cool app to show you. We don't have some neat FinTech to launch today or to put into the FinTech. But hopefully we'll have an interesting session for all of you here today. Let me just take a couple of seconds just to introduce myself. I'm Bilodeau. I'm the Director of Supervision and Promotion at the Financial Consumer Agency of Canada. At the agency, I oversee two things. On one end, I manage a program that supervises federally regulated financial entities. That includes banks, among others. And I also oversee a promotion group that conducts research in emerging trends and issues, including FinTech, as well as develop guidance for the industry. Prior to joining the FCAC, I spent 15 years at the Competition Bureau, managing a number of different investigations, both criminally and civilly.
Hi, I'm Sharissa Ellyn, and I'm a lawyer at Norton Fulbright, Canada. I specialize in financial services and regulatory matters for the payments industry. Financial services providers, including banks and many other entities that provide various types of services to their clients. Some of those touch on payments and some of them don't, and as we'll get into the details later, but what we're going to talk about is to the extent to which consumer protection regulates payments. So I was thinking in preparation for this conference and presentation, I would just bring my Payments Regulation Act and I would start reading it to you. And then you'd all know exactly how we regulate payments in Canada. But it's not so easy, and that's why we're here to talk about this topic. We can switch to the next slide. So before we really get into the idea of how we protect consumers and how Canadian laws, both federally and provincially, protect consumers that make payments, we put together this slide, which we're not going to go through in a lot of detail, and it's intended to be a busy slide. So we breached all the rules of making PowerPoints by making a very busy slide with not a lot of white space. But the point of it was to show you that we really have a very big landscape here. So there are many sources of funds. There are many methods of making payments. There are many different participants. I think that's our biggest category. So there are many different participants that work in the payment space. And there are many reasons why consumers make payments. And in some respects, to the extent that any of these variables change, that affects the legal implications and the associated regulatory requirements with that payment. To some extent, that's good, and it should be. And as I'll argue or submit, in some cases, that's not good. So it shouldn't always matter, for example, who is the supplier of that payment. So the nature of the supplier shouldn't necessarily affect how the consumer is protected when they make that payment. As was put very well this morning, I thought consumers don't really care about payments. So we're at a payments conference. The people that we're talking about who are making those payments, they don't care about payments. They care about how they're getting their products and services. And the idea is that we have the least friction possible in the payment. There are also certain things that consumers will care about and that we're going to ask you about in our next live poll, which I think is next. Yes. So we have a live poll. So since we're all consumers here, we thought that it would be nice to know what you think is the most important issue for consumer protection financial services. So I'm going to tell you how to use it, which you probably already know. So you go to your Payments Panorama app, you choose our topic in the agenda, and then you should see at the top, there's details activity polls, at least on my phone. But if you work at the FCAC, you don't get an option to vote on this poll, by the way.
We're not allowed to have opinions.
So it seems like you know how to use it. Oh, it says polling will begin soon. So I guess I'm not allowed to vote either. People are voting, so.
Well, seems like a pretty even.
Seems like people are voting. I'm not allowed to vote. Maybe speakers are not allowed to have opinions either.
Awesome. Well, well, we're not going to sit here and go through the vote.
Okay,
it's interesting that it's fairly well divided.
Okay, so in our presentation, I will question whether our laws appropriately protect consumers, we'll discuss how our laws apply depending on the method of payment that's chosen and the process that we use to make the payment. So I'll turn it over to Richard, who can describe what the Financial Agency, Consumer Agency of Canada, or as we know it as the FCAC, what their role is and how they govern consumer protection in financial services.
Thank you, Sharissa. Before I get going, just one little piece of guidance or a caveat. As I go through my presentation, I'm going to use a few different terms. Sometimes I'll use federally regulated financial entity. I might use banks. I might also refer to banks as FERFIs. Those are sort of, they're not necessarily interchangeable, technically speaking, but for today's purposes, consider them to mean the same thing, whatever I use. So let me turn on that to what the FCAC does. So the agency has a mandate to protect and inform Canadian financial services consumers. We protect consumers by supervising federally regulated financial entities to ensure that they meet their consumer protection provisions. We also inform consumers by developing resources aimed at increasing the financial literacy of Canadians by helping them develop the knowledge, the skills, and the confidence that they need to make informed, responsible financial decisions. One way that we do that at the agency is by developing consumer education material that helps consumers and merchants understand their rights and responsibilities. Some of you may have seen we launched videos earlier this year, and I think we also launched one or two last week. We launched a video on PIN protection. So we have a character that we call Floyd, and he's used to, it's a little bit haphazard, but he's used to show that consumers have responsibilities when they use their PINs, for example, but also protecting their PINs and to ensure that there's no fraud on their card. So we use material like that to educate consumers on what they need to know when they make financial decisions and when they use financial services. When it comes to supervision, the FCAC monitors compliance of FERFIs with consumer legislative provisions, voluntary codes of conduct, as well as public commitments that are meant to protect consumers. On the banking side, the FERFIs we do supervise include banks. You all know who they are. Insurance companies to a certain extent, as well as external complaint bodies, who are bodies that have been set up to deal with complaints that are sent to banks and that may not be resolved at that first level at the bank. In addition to that, so when it comes to banks, we ensure they comply with the Bank Act primarily. We also supervise payment card network operators to ensure compliance with the Code of Conduct, and I'll speak a little bit about the Code of Conduct for the credit and debit card industry in Canada a little bit later on. Let me spend just a quick minute on our approach to supervision, since that's where I'm from. It relies on three pillars: promote, monitor, and enforce. First, when it comes to promotion, we believe that compliance is facilitated when obligations are clearly identified to FIs and accessible to regulated entities. So as an example of this, in the past, to make sure that FIs know what we expect of them, we've published decisions from the commissioner when there has been a breach of, so when there's a breach of a provision, commissioner will typically, when it goes to that stage, publish a decision that's anonymized typically and put up on our website to provide guidance. We'll also issue interpretive guidances on the provisions that we enforce. I'll give you a couple of examples of those a little later on. Second, we proactively monitor regulated entities to determine whether they're complying with their obligations. Those that work in compliance and FIs know that they have to report complaints that they get or compliance issues that they identify as they carry on business. We also gather information on current and emerging issues and risks in the financial sector. And finally, when there is a breach of one of the provisions that we enforce, or a public commitment or a voluntary code, we will investigate that breach and we'll take appropriate action where we think that we need to respond to ensure compliance and deter future non-compliance. So these three pillars are the foundation of what we're developing now. So we're developing a revised supervision framework. We expect to have that out for consultation over the next few months, and we invite all of you to comment on that when the time comes.
Now I'm going to take a little different tack here and just talk about the types of regulation. So we were talking about regulating the provision of financial services and payments, and specifically how do we address consumer protection? But we've divided the types of regulations into the 4 categories you see on the slide. So what we have in Canada, unfortunately for the businesses in the room, we don't have a Payments Regulation Act, as I said, that very neatly ties up all of your obligations when you're dealing with consumers. And what we do have is a patchwork of laws that address different aspects of the financial services and payment systems. And I would say that that's because of the history and the legacy of those laws. So when many of these laws were drafted, the legislators didn't know exactly how they would be used today in 2016. And as we know, the pace of change is very slow. I think it would be fair to categorize our various laws, in addition to the 4 categories that we have on the slide. I think it would be also fair to categorize our laws for financial services into 2 basic categories. One is prudential regulation, and the other one is consumer protection. And then some might say, can add a 3rd category of laws that actually have 0 purpose and we don't understand what they're for. But in theory, the 2 categories would apply. And I would say that consumer protection is not always, can be in conflict with prudential regulation, and that is the reason for the existence of the, or at least the original reason for the existence of the FCAC. So originally we had OSFI was the federal regulator of banks, and it was responsible for both prudential regulation and consumer protection. The FCAC was created to address that potential conflict between prudential regulation and consumer protection. So we have entity-based laws. That means laws that apply because of who you are. So what kind of institution are you? Therefore, the law will apply. And a very good example of this is the laws that the FCAC enforces, such as the Bank Act, the Trust and Loan Companies Act. These are federal regulations, federal statutes and associated regulations. We have some examples of this in the provincial sphere. One example would be credit union legislation. So that applies specifically to credit unions. And those are essentially, I call them membership driven. So you apply to become a bank, you become licensed as a bank, or you receive your order to operate as a bank, and you are then subject to the Bank Act. Then we have laws that are based, and I would also add that within your institutional-based regulation, you do have specific laws that apply depending on the product or service that you're offering. So for example, if you are a bank, then you're subject to the Bank Act. You're subject to many provisions within the Bank Act that deal with being a bank, but you're also subject to specific rules that apply when you are a bank and you issue a credit card to an individual. Then you have laws. So my second category, you have activity-based laws. So activity or product-based. So theoretically, that kind of law it doesn't matter who you are. It just matters what you're doing. So we see more of that in the provincial space. So in the provincial space, we have consumer protection legislation, which covers the various activities that are being conducted. And it doesn't matter what kind of institution you are. If you are, again, using lending as an example, because it's heavily covered in consumer protection, if you are providing a loan to a consumer, then you are subject to the consumer protection requirements dealing with the loans. So the functional approach, so that's when I talk about entity-based versus activity-based, the functional approach, if you might hear that term used, that's when you say, what is the supplier doing? And then that's how we should regulate. So that aligns with the activity-based law. So it focuses more on what you're doing rather than on who you are. Then we also find laws in the provincial space that address the channel in which you're providing your products or services. And I would argue that potentially those kind of laws are not preferable anymore. So one example of channel-based laws are laws that address disclosures in an internet agreement. So we have those in a number of our provinces. I would argue that those are somewhat outdated and should probably be revisited, because most businesses are now operating in many channels, and it shouldn't be considered a particularly an area that's particularly deserving of consumer protection just because you are dealing with your customer via the internet rather than dealing with them in your bricks and mortar store or in your bricks and mortar branch. Then finally, we have laws of general application. So that's things like, in the federal space, that's things like the Competition Act, which deals with misleading advertising and deceptive marketing. We also have very similar provisions provincially, which deal with unconscionable transactions. There's misleading representations in the provincial consumer protection legislation. And I can sum that up somewhat cynically as the laws that say treat your customers fairly. So that's a law that I would say overrides all of these. So above all, you have all the specific requirements dealing with your product and dealing with who you are and what you're doing. And in addition, you have these overarching rules. So even if let's say you take the view that certain provisions, specific provisions don't apply because of what you're doing, you still need to go look at whether ultimately what you're doing, you've provided clear disclosures, you've explained clearly to your customer what it is that you're doing, what the terms and conditions are, and what fees will apply. So I think that's where we could look at the general provisions.
So earlier, I'm going to spend the next couple of slides just talking about some of the legislation and the requirements that are imposed on FIR fees. I won't go into detail on every single one of them because it would be a lot longer than this short panel. But let me get into detail what those compliance obligations are. And because this is a payments conference, I'll focus a little bit more on, or primarily on, the obligations that apply to products in the payment space. So let me start off with the cost of borrowing regulation. So the Bank Act, again, general piece of legislation that applies to FIR fees. It has a number, I think it's 26 or 27 pieces of regulation that apply to a variety of things. Cost of borrowing regulations are one of the key ones. It applies to a number of credit agreements, whether it's loans or credit cards. And what it basically says is that basically requires that FIR fees give consumers prescribed information, such as things like applicable interest rate on an outstanding balance on a credit card, information on liability for that credit card, and a credit limit, in language that's clear and presented in a manner that's not misleading to the consumer. And when it comes to credit cards, the credit card issuer, so the FIR fee, must provide the information to the customer or with the application and the credit card agreement. And the information, I know if you've seen your recent credit card agreement or application, it usually comes with a piece of paper that has a number of boxes on it and information. That information is prescribed by the cost of borrowing regulations, and those are what we refer to as information boxes. Another piece of regulation that applies in the payment space are basically the prepaid payment product regulations. So when it comes to prepaid products, consumers must be provided with key information related to prepaid cards and other prepaid products. It's important to note that these regulations apply only to federally regulated financial entities and don't apply to prepaid products that are provincially regulated, that are issued by provincially regulated institutions or retailers. And some of those requirements. So first thing I'll mention, I think it came up this morning in this room on a panel that Jacqueline was talking about, expiry dates. So FIR fees that issue prepaid cards or products cannot set an expiry date on the funds that are loaded onto them. This requirement, however, doesn't apply to promotional or loyalty products distributed by a company as part of a promotional or some sort of award program. Before issuing the card, there's also certain information that must be provided, including the name of the issuing institution, if fees apply to the card, and usually there are, information about fund expiry dates for promotional or loyalty cards. As well, when it comes to fees, another important piece here is that they have to be included in information boxes on the outside of the packaging of the prepaid card. So not only in that piece of paper that comes in when you open the package, they have to be on the outside of the package so that consumers know what they're getting into when they're buying a prepaid card. So in addition to that, once the prepaid card is issued, the cardholder must also be informed on the conditions of use of that card or the product, including the consumer's rights and responsibilities, as well as what to do if the card is lost or stolen. Now, there's a number of things that institutions are not allowed to do. For example, they can't increase fees or introduce new fees unless the cardholder has provided the institution their name and mailing or email addresses, and the bank has disclosed the new or the increased fee at least 30 days before it comes into force, and at least 60 days on their website prior to that. They can also charge maintenance fees for at least 1 year after the prepaid card is issued or activated, but that doesn't apply if the card is a promotional product or if it's a reloadable card and the consumer has given express consent to be charged maintenance fees. So those two conditions have to be present. And also, banks cannot charge overdraft fees or interest for prepaid cards or products unless the cardholder has given express consent. Next, credit business practices. The one thing I'll talk about here is that these regulations require FIRFIs to obtain express consent from borrowers prior to increasing their credit card limits, as well as before providing them with credit card checks. And one small little aside on checks. I know it came up today and we're a little bit laughing about checks, just on access to funds, because checks are still used as a payment mechanism for people, for certain individuals. When you are depositing a check, you have to make the first one. FIRFIs have to make the first $100 available for withdrawal. Moving on, so in addition to these regulatory requirements, I mentioned earlier that the agency often publishes guidance to help FIRFIs comply with the legislative requirements. We have a few of them. I think we're up to, we just released, I think, guidance 16 today or tomorrow. I'll talk about that in a second, but we have a few of them. Number one is on clear language. So I did speak earlier about clear language, and we have issued guidance about how we expect FIRFIs to go about making sure that their communication is provided in clear language. So we expect institutions to effectively demonstrate that it's applied the 5 principles of clear language outlined in the guidance. And those 5 principles are as follows. 1, know your audience. Number 2, make your material understandable by planning the text. Write clearly. Use the visual presentations to enhance the text. And finally, test your material. And I'll just say a quick note on this. The agency right now is conducting what we call it internally as a clear language review. We're reviewing credit card agreements, credit card disclosure, to determine readability and how clear it is for consumers to understand the material, and we'll make those findings available probably early 2017 at the earliest. But it's an interesting piece of work, and you realize that despite a lot of work that's gone into making them clear, they're still not the easiest thing to understand. Another piece of guidance that's important is the internal dispute resolution guidance. That's guidance number 12. So all FIRFIs are required by legislation to have dedicated procedures as well as personnel in place to deal with consumer complaints. What CG12 does, it assists FIRFIs in developing their internal dispute resolution policies and procedures to comply with the legislation. And again, we have guiding principles here in this guidance to help FIRFIs. There are 3 of them. And the first one is effectiveness. So there must be organizational commitment, adequate resources, training for staff, and monitoring and reporting systems. The second is efficiency. There must be timeliness to internal dispute resolution and in working with the external complaint body. And finally, the final principle is accountability. Again, here the bank's complaint handling procedures must be easily accessible to consumers and straightforward to understand. So it has to be easy for the consumer to bring up an issue with the bank. And of course, the policies and procedures have to be transparent, and one way that has to be done is that the policies have to be available on demand and also on the bank's website. I mentioned, we talked a little bit about the code, and I'll get into that a little bit more in just a second. When the code was amended back in April of 2015, we started developing a number of 2 guidances and updating a 3rd one to help merchants, acquirers, and other code participants comply with the new requirements in the code, specifically around disclosure and information boxes that have to be provided in the agreements. Those requirements, so when the Code of Conduct was released in April 2015, there were a number of dates that were set out for implementation. The final date's November 13th. to make sure that those information boxes are with the agreements. We had developed guidance to help people, as I said. We were aiming to get those released in May, a little bit delayed in getting that out. But if it hasn't been done already today, we'll be sending out informally the guidances tomorrow or Friday so that payment card network operators and acquirers can get going on complying with that code requirement. On the code of conduct for the credit and debit card industry in Canada, it's an important tool that governs conduct in the payment card industry. As it came out initially in 2010 and amended in 2015. It applies to, so all of the PCNOs the payment card network operators have signed on to it. Payment card network operators are also responsible for ensuring compliance of code participants, so the people that are downstream of them with ensuring compliance with the code. And the FCAC is responsible for monitoring that. So just a quick word on that. I know we're running quick today, but relevant to this group here, we get asked oftentimes a lot of questions about the code. They're mostly written as they're not as prescriptive as regulation. We're often asked to interpret what this provision of the code means to this particular type of product. And when it comes to that, we do try to balance the intent of the code, what the words of the code say, but also try to balance innovation and make sure that at the same time as merchants are protected, that businesses can launch new products and consumers can benefit from them. It's not always an easy exercise, but we try to carry out that balance as best we can. Another code of conduct that we administer very quickly is the Code of Practice for Consumer Debit Card Services. It has a number of requirements in there. Among them, it deals with fraud and liability coverage as well. And finally, just on a public commitment that we do administer as well is the zero liability on credit cards. We do oversee the commitment that was made by the various payment card network operators in that regard.
Okay, so we are getting tight on our time, and I want to allow some time for questions. So with respect to provincial consumer protection, these are you see on the slide the basic topics that we cover in provincial consumer protection. So what I thought might be a bit more interesting to you is to talk a little bit about how this is enforced provincially. And the answer is there isn't a lot. There's some in Quebec, and there are some enforcement actions, but in the financial services space, I have not seen a lot of enforcement from provincial regulators. What I have seen a lot of is class action litigation. And so what I would like to do is question whether class action as an enforcement tool is an optimal method. And I think many of us in this room will agree that it is not. And I would also bring to your attention just some recent class action decisions. So I would argue that it would be preferable if there was effective regulatory enforcement from the regulatory front rather than having the plaintiff's class action bar be the effective regulators of provincial consumer protection legislation. And partly, and maybe this will be viewed as a criticism of the plaintiff's, the class action process and plaintiff's class action lawyers, but there's a recent case out of BC where it's Finkel versus Coast Capital, the class action was certified on the basis of alleged non-disclosure of a foreign exchange markup when the debit card was used to withdraw foreign currency at an ATM. Now, the fact scenario here is somewhat similar to a case that many of you here may be familiar with, which is the decision of the Supreme Court of Canada in Marcotte. It's quite a similar fact pattern, different product, but essentially the allegation is that the credit union didn't disclose to its customers that when they use their ATM they use their debit card at an ATM, in addition to the fee charged by the networks, in this case Sharissa and the other ATM networks, the credit union itself was charging a markup on that. Yes?
I was counsel on that.
Oh, okay.
Defense counsel.
Okay.
That actually isn't quite correct.
Okay, so you can correct me if you'd like.
Yeah,
Yes.
The allegation is that the credit union was receiving on the rail, paying on the rail, already converted to Canadian dollar currency. That ping, whatever the dollar amount,
Yeah.
had been converted on the rail at an amount unbeknownst to the credit union,
Okay.
depending upon exchange applicable to the exchange rules
Yes?
by which that transaction is converted. So it was different than the Cirrus or Plus network,
Right.
but it was not a charge imposed by the credit union.
Okay, in any event, so I guess, so I'm not disagreeing with you, but my point that I'm trying to make here is that the problem for the alleged problem brought by the plaintiff is that the plaintiff did not understand the rate. The plaintiff was not given disclosure of the exchange rate. Do you agree with that?
Yeah, the allegation is that the plaintiff did not know what the exchange rate would be, but the reality is neither did the credit union.
Right. Okay. And so what I read, so you know this in greater detail than I do, but what I read is that the individual representative plaintiff suffered a loss of $11. So the question is whether, this is the way we should be enforcing our breaches of consumer protection. So this person, and likely many of these other plaintiffs, each suffered a loss of $11 or less. We have many other examples where the individual plaintiff suffers a nominal loss, and then the class action gets certified so that all of these customers can recover a couple bucks. And the plaintiff's lawyers make a lot of money on this, and the defense has to pay lots and lots of money to defend these actions, which may never actually get to trial. We may never get a decision on the merits. It's a rare case where we get a decision on the merits. So I'm just raising questions here about whether this is the appropriate enforcement. Another recent case that I think is interesting just to mention is the decision of the BC Supreme Court in Jiang. So that's a prepaid card case, and I have Peter here from People's Trust, so he can also correct me, serve as a check on my facts here. Yeah. So in this one, what I'm pointing out here is just an interesting aspect. So this particular case, certification was denied, and I understand that the case is under appeal. But in the denial of certification, so this has to do with the issuance of prepaid cards, and the class is supposed to be consumers in British Columbia. The problem is, with the definition of the class, is that you cannot tell at the outset whether an individual end user of a prepaid card is or is not a consumer. So the plaintiff's class could not be defined at the outset, and as a result, the court held that the action could not proceed as a class action. I may have misstated that, but my point is I thought it was very interesting that we have consumer protection law, we have prepaid cards. The court said, and this may be something that the defendants take issue with, the court said that the cards that were issued by federally regulated institutions were subject to BC consumer protection law. That's at the class action certification stage, not at a decision on the merits. But the court did say that, and yet we don't know if the person using it is a consumer or not, so the class action wasn't certified. So a good result for the defendants, but not necessarily a good precedent in law. Okay, so finally, we wanted to get to some issues and challenges raised by our current laws, and to have a brief discussion, I think, because we don't have much time left, as to whether our laws are keeping pace with the products and services that we offer to consumers. So I don't know, since we don't have very much time,
Sure.
Do you want to?
Absolutely. So let me get into this a little bit. It's a little bit hard as a regulator to say whether or not the laws are keeping pace, because as a regulator, we enforce the legislation that's given to us. We don't make policy. We don't develop the legislation. That's up to the government and the Department of Finance. But what I will say is that we are seeing how new technology is coming on board. It's developing fast. It's bringing significant benefits. Significant changes to the financial services industry. We look at FinTechs. We've heard from a few of them today, Coho being among them this morning. It's very cool to see all of these products. And for consumers, there are tremendous benefits potentially. There's more options for them. It maybe solves a problem for them. And it maybe also offer lower cost, lower pricing for them. But there's also a potential risk associated with that. Is there inadequate? There's a potential for, if you're operating outside the regulatory framework, there's risk for inadequate transparency and disclosure, a lack of dispute resolution, there's risk of default, insufficient liquidity, potentially privacy concerns. Again, not my responsibility, but that's something else that we've identified. And it poses a challenge for us at the agency, and I'm sure for other regulators in this space. Yeah, fintechs seem to enter at every week you hear about a new one. There's another article in the Globe and Mail about this fintech or that fintech. I think we heard today there's over 80 of them in Canada. We've had over $1 billion invested. It's changing fast, and I think Jacqueline, put it best. We need to. It's hard. You can't get ahead of the curve. It's changing too fast. But what we're trying to do at the agency is to understand what fintechs are doing, whether or not they're partnering with FIRFEs or operating outside of the regulatory framework. We want to understand what companies are out there, what they're offering consumers, not because we want to go to them and say, don't do this, it's not right. We want to make sure that we understand what they are so that we can balance our enforcement. We can suggest best practices. We talked about requirements for clear language. Those requirements apply to FIRFEs specifically. That doesn't mean that a fintech that's operating outside of that framework can't adopt that best practice. It creates confidence for the consumer. It builds trust in that fintech because we're giving the customer information. So there's advantages to that. And also, because we have a mandate to educate consumers, we're looking at fintechs. We're trying to develop consumer education material that's going to educate consumers about the benefits and the risks of using fintechs without necessarily picking winners and losers. And finally, I think what we're going to be doing, or what I know we're going to be doing over the next few years is, especially specifically on fintech, is researching them. We may publish something over the next few years, over the next year. But we want to be able to contribute to any policy discussions in Ottawa about what to do when it comes to potentially regulating this market, if ever that's a decision that's made. But I have one more message on that. I'll keep that for the end.
Okay. So I have a lot more to say, of course. As you can see, I don't run out of things to say. But we're going to leave this for you to think about. We can talk about some of the issues and challenges if any of you have time to stay after for questions or later in the conference. But I think we'll skip to our last slide, where we just wanted to give you a few best practices in terms of your product development. And some of these I think you're probably already familiar with. They go without saying. One thing I wanted to point out here is the decision of the Supreme Court of Canada in Richard versus Time. And that is a misleading advertising case. And I won't go through the facts, but it related to, and Richard I'm sure is very familiar with it, but it related to an advertisement for a prize. And so you can look that up on your own time. But the reason why I point that out is in designing your product and services, as well as your disclosure to your consumers, whether or not what you're doing is specifically regulated with prescriptive requirements, I think we should all keep in mind the message from the Supreme Court of Canada in Richard versus Time. So when you're considering whether, in that case, whether the representations were misleading, and I would say you can generalize that to any consumer-facing disclosure, the perspective to use is that of a relatively unsophisticated consumer who is not particularly experienced at detecting subtleties. So I think that's very instructive. So we as lawyers are very experienced at detecting subtleties, and sometimes the subtleties are very important. But to the extent that the end result, your document is full of subtleties, your consumer, at least in the eyes of the Supreme Court of Canada, may not be able to understand it. So I think that means that sometimes you have to go back to the drawing board. So if the disclosure that is required to cover all of your subtleties is so complicated that the average dumb consumer isn't going to understand it, then you need to figure out whether your product is overly complex and has to be simplified.
And if I can just conclude on this on my part, I think you've heard it a couple of times today. I think it's important to, when it comes to dealing with regulatory agencies, it's important to, as you're developing products, to engage early and often and talk to us. I know at least at the agency, my door is always going to be open to meet with the fintech to understand their product so that we can ask questions. We can provide valuable input for product and service development that may avoid, we heard today, compliance sometimes comes in as an afterthought, and by the time it comes in as an afterthought, it's too late. So you can avoid a little bit of dealing with that issue. It's also beneficial to us as regulators to as an important source of information as we get up the curve on fintechs, understanding what the technology that's out there. On best practices, as a regulator, we would encourage non-regulated entities to follow or at least be inspired by the existing regulation and guidance. As we said, they've been developed over many years. They can be very useful in building confidence and trust. And they can provide a benchmark for entities in terms of consumer protection. It can promote good business practice and create value for consumers. And finally, some specific areas that you may find useful, especially for the, as you're developing new products, guidance around clear, simple, and non-misleading disclosure, to your point, when you're dealing with a consumer that may not be as sophisticated as the people here in this room.
Okay, so
Thank you. Any questions?
Yeah,
I think we have a few minutes.
Hi, I'm from the BC regulator, FICOM.
hello.
So thank you for the presentation. I just want to touch on a point where you mentioned that, also on the provincial level, at least from the report you can see, there hasn't been much sort of enforcement or
Mhm.
kind of official decisions handed down. There's a wide spectrum of how much a regulator gets involved in sort of consumer protection matters, or trying to understand technologies and things like that. So when things go public, right,
Mhm.
that's kind of our last resort.
Yes.
Right? We don't want to, just start issuing, cease and desist orders and, decisions here and just, basically telling what the industry will do. So what we try to do is, start by understanding, right, where the industry is going, what the industry is doing, and what are the specifics, just so that you what kind of given. And then, we receive consumer complaints. Then the first thing is, we try to establish facts, of the case. And also we fight in definitely the FI that sort of, with the case, sort of alleged activity. And then we try to work out things kind of in the background. We use a lot of more suasion to try to sort of rectify the situation.
Yeah, so it sounds like your approach is great. So I wasn't criticizing the regulators. I think that's excellent. It's very collaborative. But my point was that it seems to me businesses are much more fearful of the threat of a class action than regulatory enforcement. Of course, I would always advise my client, if you're going to comply with what it says in the regulation, if you get a regulatory communication, you're going to deal respectfully and appropriately with the regulator in a collaborative manner. But you don't have that option when you get faced with a class action, unfortunately. And so my point is just that I think there's something wrong with the way that these class actions get certified to address non-issues, issues where the business did not fail to protect consumers. So that's really my point. I wasn't meaning it as a criticism on the regulators.
Don?
I just want to make a comment because I'm from British Columbia. I'm also a business counsel. Suasion can work, but suasion has to go with proper law enforcement. If you don't have well-advertised law enforcement where people pay penalties occasionally, moral suasion and voluntary compliance is not an effective tool. And that's been our experience everywhere. The other point I wanted to raise was a broader one. We're talking about best practices. One best practice that we believe that FCAC is moving towards is something that the Payments Canada has been doing for some time very well, and that is consultation. And one thing the consultation would enable you to do is be more aware of trends in the marketplace with a well-balanced advisor group that represents business, consumers, governments, and so forth. So I'd like to commend that.
Yeah. Thank you, Don. Thank you for raising it. Don's right. So Don's aware of this. So the agency is going to put together. It should be announced over the next few weeks. Right now, it's called Consumer Protection Advisory Board. That name may change, so don't quote me on that. It's meant to get a group together from consumers, businesses, academics, not-for-profits, talking so we can exchange ideas, exchange information about what you're seeing within your communities that you serve, trends that we should maybe be focusing on. We have a research mandate at the agency, not just about payments, but about everything. We have a research mandate at the agency. We did a paper this year on extended term loans for automobile financing and the perils of getting into that. So it's important for us to get feedback from the marketplace and from consumer groups and others, and we are going to be doing that, announcing that very shortly. So if there is interest in that, when you do see that news release out, I invite you to apply. But Don, you're absolutely right. Consultation is key on the issue of FinTech. Part of our strategy there is to go out, meet with these FinTechs, understand what they're doing, understand how FIs are collaborating with them, as well, to understand what obligations or disclosure obligations the FI have, but also to just to better understand. I think when you understand things, you can better prioritize and act when things go wrong.
I just wanted to carry on with one comment that Sharissa was making, which I think is very valuable. The consumer class action really fundamentally is an opportunity for plaintiffs' consumer class action counsel to plead a good statement of claim, not to assert a valid cause of action per se. It matters not whether the claim is valid or invalid. So it's just a threat out there that stands to the risk of all financial institutions and frankly those of us who try to draft agreements to comply with each and every regulation that we apply. Now, when we think of consumer protection laws, they came up in a point in time in our history when information was one-dimensional. In other words, consumers couldn't contact one another and report upon concerns about the conduct of institutions or organizations. Now we have very effective regulators who have codes, and I applaud the FCAC for the voluntary codes. I think they're very useful for assisting us in drafting the agreements. But we also have social media, and social media actually plays a very significant part in all of my client relationships about what financial institutions are doing well or badly, and the complaints that can be made with respect to them. So, no business wants to go out and take their customers to the cleaner because they're going to be pilloried within the social media platform. So the class action, that is, frankly, any sort of mandatory regulation creates an opportunity for class action counsel. Voluntary codes do not. Voluntary codes get the organizations around to where they need to be, which is have clarity in language, have clarity of thought. Social media will ensure that the best organizations will survive. And I'm not sure that, continuing on with a stronger and more defined regulation and changing from voluntary codes to mandatory codes does anything more than enrich plaintiffs' class action counsel and perhaps also defense counsel like myself.
I guess if there's anybody from Payments Canada, so I got that right. Yeah. Payments Canada in the room, maybe that's a topic for next year, regulatory enforcement versus class actions.
Yeah.
All right, I think we're out of time here, but at least I'll be around. I think you'll be around as well, so we can talk to us later.
Thank you.